Steps and timescales involved in a company liquidation. Basically, there are 8 steps through to the finality of a company through the process of company liquidation. Step 1, decision. If directors recognise that the company is struggling to survive, they can undertake what is called a creditor's voluntary liquidation. This sees them control the process out, appoint their own liquidators, pass the necessary resolutions, and this is then ratified by the court. There were 23,000 creditor voluntary liquidations in 2024. Alternatively, if a creditor pursues a company and decides to issue a winding up petition, this is called a compulsory liquidation, and the company and the directors are at the behest of the court and the creditor action. Step 2, the appointment of the liquidator. A creditor's voluntary liquidation sees the directors discuss the issues and decide who they should appoint as their liquidator. If it comes to a compulsory liquidation, that sees the court and/or the official receiver decide, if appropriate, that a liquidator is appointed. Again, it's a control aspect, really. 3, at that point, the company ceases to trade and the liquidator is in control of the company and runs all its affairs through to its finality. 4, there is a time-specific requirement for the directors to assist the liquidator in the preparation and filing of what's called a statement of affairs. This has to be filed at Companies House within 21 days of the liquidation and sets out the financial position of the company, listing assets, expected realisation, and as much information as is available in respect of all creditors. Step 5, asset assessment and realisation. The liquidator is in control of all assets, and his job is to maximise their recovery so that he can seek to get some return for the creditors involved in the liquidation. These include current assets such as any available cash, free assets and free stock. Also, they must realise and sell all fixed assets such as cars, equipment, lorries, etc. If any of these assets in any way secured by way of a fixed and floating charge, those assets technically belong to the supplier of the finance supporting that. For example, a sales ledger book may be financed by a factoring company. Step 6, the liquidator must conduct an investigation into the director's conduct up to the point where the company went into liquidation. This sees them look at misfeasance, possible misuse of funds, such as the over-reliance on a director's loan account, which becomes overdrawn, misconduct, and wrongful trading. A report, whether it's good or bad, is then filed with the insolvency service for the conclusion of that element of the liquidator's work. Step 7 sees the distribution of funds. All assets are realised where possible. Fees are taken at that stage to make sure it's enough for the liquidator to complete his work. Then there is a strict order in terms of repayment. Step 7, the distribution of available funds. Once all assets are realised, a pool of money is gathered together and then it is distributed. In the first instance, the liquidator and his advisors will look to recover their fees first. Secondly, any monies owed to any secured creditor are then paid, and then from there the preferential creditors are dealt with, typically HMRC, and finally the unsecured creditors, usually in the form of trade creditors. Very rarely, if ever, are there any more funds available for them for the shareholders. The 8th and final stage sees the dissolution of the company, where all reports have been made to the various authorities and creditors, and the liquidator is required to file the final papers in respect of the dissolution and ultimate closure of the company. In terms of timetable, there are strict early deadlines, but each case is dependent on the complexity and the findings that arise from the liquidator's work.